Good evening, everyone, and thank you for joining us on this call, which we have organized for you to share with you our update on ABSL Credit Risk Fund. As most of you would be aware, we are reopening this fund for subscription after about 13 months. All of you would remember that on 22nd of May 2020, we had which was like almost after the peak of credit crisis in post-COVID situation in the month of April, when one of the reputed fund house sort of stopped further redemptions. In the month of May, we thought that it's the right time for us to because we were fairly positive on incrementally on the credit environment, and our portfolio was ready in terms of our liquidity, and therefore in the interest of existing investors, we thought of stopping subscription temporarily and voluntarily. So we did that on 22nd of May 2020, and it was with an aim and an endeavor that the existing investors over a 12 to 18 month period should kind of experience or could experience anywhere between 10 to 12% kind of return in credit risk fund and 15 to 18% kind of return in medium term plan. And we're very happy to share with you that about 1 year, 1 month out as we speak now, our portfolio delivery, performance delivery and credit risk fund is over 12% annualized, and also in medium term plan it's like 16.5% plus. So we have been able to kind of pretty much deliver what we were targeting at that time. And very happy to share that we had resolved one of the asset under resolution that was IETS. And also we had kind of for a few quarters, we did not charge management fees. All of this was kind of intended to make sure that we serve our existing investors in the portfolio and we don't see any dilution for their interest as well. Also the fact that the portfolio was very, very liquid, even immediately after the crisis, it took us some quite a few people were also surprised that we said that someone said no redemptions, we said no purchases, and redemptions were kind of okay for us to kind of service. And that really talked about the quality of portfolio and the liquidity that was available in the portfolio. So as we speak right now, we have opened up the fund for the subscription only in credit risk fund and only up to 1 crore per day per investor. And our belief is that in terms of our credit or accrual as an investment category, we have always believed over the last decade or so, we have mentioned on various forums and in various conversation formats that accrual is going to be a very big category. It always happens to be so in any evolved capital market, and our Indian mutual fund industry will also not be very different. So we are going to see a very secular growth in accrual category. That was our conviction then. That is our conviction even now. So we have our fund manager, so I will not talk too much about what is the credit environment looking like at this point in time and what kind of promise does it hold for our investors, long-term investors in fixed income. So I don't want to get into that space when fund managers themselves are available to share with us that part. A couple of things I wanted to highlight before I kind of invite Sunaina and Mohit to share their views on the portfolio, on the some of the assets that you would want to know and update on, and in the future. So a couple of things I wanted to highlight is that, as all of you know, that since 2011 or 2010, 2011 to 2017, 2018 financial year, we have had a phenomenal run in terms of the portfolio and performance across our accrual products. And whatever worked during those times kind of benefited most of our investors, all our investors during that time. But the same thing did not work necessarily in 2018 and 2019 when the credit crisis kind of emerged. And of course, we were also kind of affected in the entire process. What was important, however, is that we kind of wanted to learn a few things that could really help strengthen our investment framework and portfolio construction framework, such that it becomes foolproof or it becomes stronger for the ensuing market cycles as well. And two of the key learnings that we have had, I'm sure our fund managers will talk about it, so we'll not get too much into detail. All that I want to say is that we are much better prepared in that sense, with minimum diversification criteria in our portfolio across securities as well as across rating profile or rating buckets, just to make sure that our portfolio is ready for any kind of market cycle going forward, such that we kind of manage credit risk in a much better manner, and also our portfolios are also liquid at all points in time. So that's a little bit on the past side. In terms of future, what do we expect to kind of, or what do we endeavor or aim to deliver for our investors, long-term investors in fixed income, particularly credit risk fund, is that any investor who is coming in or the fund on a rolling basis for a 3-year period or more, we would aim at delivering conventional savings instrument plus, and that would be our endeavor. And very happy to share with you that since inception till yesterday, if you were to do a daily rolling return of credit risk fund, average 3-year return of credit risk fund, ABSL credit risk fund, is 6.74%. And if someone had done SIP, at the beginning of the fund itself and continued till yesterday, the return, Friday, the return would have been 6.88% XIRR. So given the market environment, interest rate outlook that we have, we believe that it's a very sound proposition as an alternative to recurring deposits for investors. And we believe that it has a long way to go as a category, a role as a category. And we are quite committed to be a part of it and serve our investors and partners through this proposition called Aditya Birla Sun Life for Credit Risk Fund. So let me stop here and invite Sunil to kind of share with us the way forward for ABSL Credit Risk Fund and the portfolio construct. So what is Sunil?
Thanks so much, Bhavdeep, and good evening to everybody. Before we get into specifics of Birla Sun Life Credit Risk Fund, maybe I'll just give a little bit of a backdrop and give you our view of how we see the credit markets today and the macro background that we currently see. Last year, because of the pandemic, we saw across the entire globe, governments as well as the central bankers actually coming together. And, together, monetary as well as fiscal policy tried to pump prime the economy and ensure that there are no shocks to the economy due to the COVID pandemic. In India, similarly, in India last year we saw, because of the pandemic, a complete lockdown, and thereafter we saw both monetary as well as fiscal. That's the RBI as well as the FinMin acting in tandem to try and shore up the economy. So the finance ministry on its part came out with a slew of schemes, including the PLI schemes. Of course, previously they had cut tax rates. And they also announced in their last budget in February the fact that for the next many years, they are going to be looking at an additional 2% fiscal deficit, higher than what we've seen an average of the last 5 years. And that is being done primarily to, the excess spending will boost the economy. The RBI on its part last year cut rates very dramatically and has also ensured that a large amount of liquidity remains in the system. And while the economy has seen a fair amount of a rebound and an uptick, our sense is that RBI will continue to retain this very, very large amount of liquidity in the system going forward as well. So what does that all mean for Indian corporates and corporate health? Because that's the most important for us. We've seen that, because of this, because of, all the measures taken last year, particularly for the large and organized players, and that is the universe that we as a mutual fund operate in and invest with. Those are the ones who have actually benefited. Lots of the large companies have taken advantage of the low rates in the economy due to RBI's cutting of interest rates, and they have repriced and refinanced their costly debt. Many of them have elongated their maturities. A lot of them have actually taken advantage of the very exuberant equity markets and raised equity, thereby deleveraging their balance sheets. Also, over the last 6-9 months, we've seen commodities actually pick up very dramatically, and a huge uptick in commodity prices, metal prices, etc., which has which along with the tailwinds in the economy has seen a lot of the cyclical companies really in an upswing and an upturn very quickly. As a result, if you look at the profitability of a lot of those cyclical companies, they're at some of the best points ever in the last 5-7 years, this last quarter. In general, on average, we've seen corporate profitability really improve in the last quarter or two. So Indian corporate health seems very well placed. Balance sheets are well poised. Profitability seems good. And hence, in this background, in the fact that, over the last 1 year, duration capital gains are behind us. Most of them have come in the last 1 year, and now onwards we probably start seeing some effects of normalization creeping. So in this background, then it is for the next couple of years, a fixed income investment strategy should ideally be a yield maximization strategy. And that's when accrual and credit funds actually play a fairly large role. And those are the funds that actually target or look to target yield maximization strategies. So in this backdrop, we've looked at the fact that corporate balance sheets are very well placed. You've got this is the time to look at yield maximization, as well as the fact that in a scenario when there is an uptick in the economy, it's likely that you will have some amount of credit improvement, and hence there will be a fair amount of rating upgrades that we can look to take advantage of by identifying them well in advance. So in this backdrop, it seemed prudent to relook at reopening our credit risk fund for subscriptions. I'll hand over to Mohit to take you in more detail on the portfolio itself and the portfolio construction.
Hello everyone. Sunana has covered the backdrop, and I would broadly cover what changes or what learnings we have taken from our experiences, as well as from the experiences of other industry players in our industry. So after last year's events and the events that played out in 2018 and 19, we have tried to further strengthen our credit appraisal processes. We have added certain layers of appraisals, and there are certain processes in place which takes care of the early warning signals. So every week we meet with our CEO and discuss specific credits. Every 3 months we review our credits in terms of any new events playing out there, or early warning signals in terms of some regulatory changes, or some commodity move, or certain other political moves, or anything on earth that can actually change the view, the outlook on the credit that we hold. And there are certain layers to it, as in we firstly discuss amongst ourselves in the team, then the CEO level, then it goes to IC level. So there are 3 levels of it. So that takes care of any shortcomings or anything anyone has overlooked at a certain level, so that gets covered. Apart from that, on the portfolio level, based on the experience that when AUM decreases, your percentage exposure suddenly can shoot up. We have put in certain binding constraints in terms of how much exposure, as a percentage of AUM we can take for an individual issuer or as a group, based on what rating it has, and there are certain other criteria. So broadly, these are the 2 major processes in terms of the credit underwriting, credit follow-ups, and the portfolio construction is broadly that we have taken up. Apart from that, liquidity has been our hallmark always. Even last year, when a certain fund house closed out its 6 funds, we continued to honor the redemptions through a normal route, rather than doing some slightly different practices. We continue to do in a normal route, and after a point when we thought we need to protect our current investors, we actually stopped the subscription because we are very confident about the portfolio that we are holding, and continue to honor the redemptions. So liquidity has been our hallmark, and we continue to pursue the same strategy on liquidity going forward as well. I would stop here. Bhavdeep, maybe we can start questions and answers. Thank you.
Yeah. Thanks, Mohit and Sunena. Yeah, so we have received a few questions. I'm seeing some of them have been answered. Some of them we can just take. Mr. Venkataramana is asking, ABSL being such a consistent fund house in the corporate debt space with processes and system in place, how come there are so many funds which got impacted on performance along with segregation of portfolio, shutting down of subscription, etc.? May I know why this has happened post the IL&FS crisis and what measures being taken to safeguard in the future? So I think Mr. Venkataramana, I hope your questions have got answered in terms of what we are doing to safeguard, or to kind of make our portfolios, ready for any kind of market environment, both for liquidity and as well as the credit risk part. What has happened was, as I mentioned earlier, I think our investors and partners both would be aware that since the time we started managing our medium-term plan as an accrual product, all the way right from I think 10-11 all the way to 2017-18, it worked extremely well. And then in 2017-18, as the credit crisis happened, I think on hindsight, as Mohit very briefly touched upon, there are two elements which we now believe that we need to kind of address. One is it's not sufficient that you have enough number of securities or the covenants at a security level in which we are investing, but on the entire ecosystem of the group where we are investing, because any part of the group weakening could have an impact on the exposure that we have had. So I think there is one learning, Mohit very briefly touched upon that, and that now we have put in as a part of our risk management system as well as the credit appraisal system. That will, I'm sure, will come handy across all credit cycles in the times to come. Another factor was that, as Mohit talked about, when the peak of credit market, the positive cycle, the industry AUM in credit market was like 1,30,000 odd crore. It came down to about 30,000 crore, in 2020. And we realized that the same exposure that you have, even 3 rupees, that becomes 3%, that becomes 10%, just because there is a AUM drawdown that happened in the credit cycle. And therefore, we have instituted certain limits for maximum exposure to a given security, and also minimum diversification across our credit rating buckets. And that really helps us, that will make us ready for withstanding any portfolio, any credit market environment that could happen. So I think that is broadly the thing that Mohit covered, and I just kind of reiterated a couple of them. One question is from Mr. Jagdish Parekh. He's asking a question, sir. It's good news that we are accepting new amount, but whenever segregated satellite. Okay, so to that, may I request Sunena or Mohit to kind of very briefly share as to what is going to be the impact. First of all, so while Sunena will share with us the update on Adilink exposure, but reopening credit risk portfolio has nothing to do with it, because the investors who had been in the fund at the time of segregation will continue to get the same benefit, as and when the segregation, this asset is resolved. In terms of the timeline and update, timeline very difficult to say. You all know that resolutions are not unilateral decisions. There are multilateral decisions and multi-layered decisions. So it takes time. But for the latest update, Sunena, could you please share with our partners how should they look at it? Thank you.
So, Adilink was one of those investments that has actually been very deeply impacted by the entire COVID and pandemic. As you know, this security had this investment had as its security a basket of roads, of which two are the ones that had reasonable value. One was a state toll road, the other one was a state annuity. The state toll road, just like all tolls in India, have had the issue of, having toll revenue being impacted. Last year, at the height of the lockdown, no tolls were collected anywhere in India. So for 2 months, there was absolutely no toll collection. And also now again in the second wave, because the road is in a state that was impacted by COVID, again, there has been a reduction in toll collection revenues. So we believe that investors in this asset or to buy this asset will look to ensure that there is some amount of stability in revenues before they actually give it an equity value. Because don't forget, we recover from equity value being assigned to this asset. And it's only when there is growth and stability first, and then growth in toll revenues, that you will get some equity value out of it. The second road was a toll road, again a state toll road. State finances have been badly impacted because of COVID. Most of the state governments have financially had reversals because of the pandemic and the unexpected expenditure they have had to make. And as a result of which receivables have been stretched, and same has happened with this asset. We are working on a two-pronged approach. We're looking to see if we could, look at sale of the NCDs, and also through our investment banker who we've appointed, sale of the underlying assets. And, we are trying to ensure that, while at the same time we try and get the best value that we can for our investors, we're also very aware of the time value of money. And hence, we will evaluate each and every, bid that we get in such, keeping this framework in mind. As far as timelines is concerned, Bhavdeep's right. It takes this asset has been impacted. It's taking much longer than we originally anticipated. And it's very difficult to put a timeline on when exactly it will get resolved. So, with that, I'll stop.
Yeah, sure, Sunena. So one question is from Mr. Subhashish Majumdar from Kolkata, and gentleman is asking why an investor should invest in credit risk fund when low duration fund is giving even better return. So any one of you would like to answer, or you actually are co-head besides Sunena, our co-head fixed income. Kaustubh is also here. So even Kaustubh, would you like to sort of take this question as to how? Well, I'll repeat the question.
Okay, so it's more of a asset allocation question, Bhavdeep. Look, of course, low duration funds, it's a good franchise, but you need to understand or appreciate the fact that the total duration that we run in low duration fund is 6 months to 1 year. And so accordingly, the duration which is available in this is a lot lower. And which is why when investors are coming from a 3-year perspective, they need to look through the cycle, which is beyond 6 months and 1 year product. So the point is that when you are exposing yourself, if you have a 3-year horizon for investment with us, and if you are investing in a vehicle which runs or which has a cap and floor of duration of 6 months to 1 year, you run that kind of reinvestment risk. Now, as what Mohit told you, is that our sense is that broadly, the macro tailwind is there in the economy, which means that we expect that over the course of next 3 to 5 years, economy is likely to do well. And both banking balance sheets and private balance sheets, they are much more stronger today than what we have experienced over last 5 to 7 years. So our thing is that the term premium, which is already built in these 2-year to 3-year products, they are adequately pricing in both the rate hikes and the credit compensation given the quantum of liquidity which is available. And which is why our suggestion is that from a diversification perspective and from an asset allocation perspective, you could look these funds with a 3-year investment horizon. So in a nutshell, the point is that while you're investing in these funds, you need to have a 3-year investment horizon so that you can play out both the credit cycle and liquidity cycle well. And so these funds are better proposition, or they are as good as proposition as a low duration fund.
I think it's in the beginning itself, you mentioned that it's an asset allocation, actually a related question. So I think both the funds have their own relevance in investors' portfolio, depending on the investment horizon that you have. And that's how and for credit risk fund, as I mentioned earlier, as a house, we believe that if your investment horizon is 3 year plus, this could be a good kind of category to sort of look at it for, beating the conventional savings, invest products returns. One question.
If I can add up here, because I think because the question is very pertinent in the sense that you need to look upon fixed income incrementally for next 2-3 years as a yield maximization strategy rather a duration gain strategy. And the only way to do it is that you need to realign your investment vehicle with your investment horizon. So what our guidance to the investor per se is that if you have a money which is likely to have a visibility of 30 days to 60 days, then liquid fund make more sense. If it is 60 days to 90 days, then money markets and ultra short term make more sense. For a low duration, you need to have an investment horizon of 6 months to 9 months to play out the duration and the liquidity cycle that we envisage. And for the longer duration horizon, you need to look upon the product which moves in this range of 1 to 3 years because of the steep curve, which is already pricing in a lot of rate hikes, and the credit spreads, which are already built in after adjusting the amount of liquidity that we are into, they are near to the median levels. So when we are guiding to the investors, or rather our partners and distributors, they are on further guiding to the final investors, they need to reassess the investment horizon now, and accordingly they need to guide the better investment vehicle which suits their requirement.
Mr. Pramod Nayaki from PN Wealth is asking, is there any update on introduction of CDS in India or any other credit risk mitigating insurance tools in Indian debt market?
CDS, I mean, the RBI has tried to launch a couple of times, and still there are, SEBI is also getting involved. I mean, SEBI had, just before the, COVID related lockdown started, in Feb, SEBI had invited 3 mutual funds and a couple of bankers to discuss, discuss the issues related to CDS and how we can, structure the product so that it becomes widely used, because the earlier experiences have been that twice they have tried to launch it, but somehow it did not pick up. So of course there are there are discussions which are on, and certain regulators are obviously they are regularly trying to get us engaged in a discussion and trying to find out what they can do from their end. So I mean, the process is ongoing, and we are hopeful that something with active regulators and industry also wanting these instruments. I mean, something should be doable, I think.
So Bhavdev, if I can add one more point here. So look, on a fixed income, there are broadly 3 risks that's are there. So one is of course the liquidity risk, one is duration risk, and a credit risk. Now, as far as the duration risk is concerned, so now SEBI has clearly come out with a scheme categorization, which gives some bit of a binding constraint for each category level, what kind of duration that we can run on. And also SEBI recently come out with a potential risk circular about 10 days back, where upfront fund manager themselves will give some kind of indication that what's the maximum Macaulay duration that they will run in each fund. So that's how that risk is being addressed. The another thing is what credit risk, for which the CDS is being worked upon in line with what Mohit has guided us. And the third risk is, which is a liquidity risk. Now, to address the liquidity risk, there are series of steps which has been taken both at a mutual fund level and at a regulator level. At a regulator level, they have introduced these LCR norms, where each fund need to maintain at least 10% of the fund into liquid assets, and probably these will get further tightened by way of overlay of individual funds, because when funds are managing the liquidity risk, they're also closely watching it. Basis their liability profile, they will be in keeping a higher amount of liquidity, which should be suitable to make sure that as an industry or as a fund, we don't run enormous amount of liquidity risk. So I would say that as generally set out, that every crisis generally lead to a better industry and a better way to fight the future crisis. The crisis which we saw between 2017 to 2019, specifically on credit part, and then what happened last year, which also highlighted some bit of liquidity risk which was there in the industry. Industry has evolved from there, it has learned from there, and on top of it, regulator is also acting on a front foot for all the investors to make sure these risks that the investors are citing off, to a large extent they are taken care of. So having said that, I'll not say that now as an industry will never ever have any kind of risk. So that's not what I'm trying to say. What I'm trying to say is that as an industry, we are much well prepared today to handle all three kind of risk whenever these risks materialize, or whenever the call for these risks comes over course of next future growth.
Cycle, yeah. Yeah, thank you, KG, for Kaustubh for that. Mohit, one question is from Mr. Varad Kamath. He's asking, what will be the duration and how will AMC manage rise in interest rate?
Yeah, so current duration, for last few months, we are maintaining a duration of around 1.6 to 1.7. So broadly 1.5 to 2 kind of a range is what we are managing for last several months. And as the yields actually go up, firstly, the credit, the high yielding credit papers would be a buffer to the rise in yields, as Sunena pointed out. The second thing is that we would be running right now running a duration of around 1.7. The investors who are coming in for 3-year plus kind of horizon. So I mean, as the maturities happen and the yields rise, we will continue to invest at higher yields. So that will be beneficial to the investors. I mean, running a lower duration than the investment horizon of the investor kind of helps us, invest incremental money, the maturity that come through maturities at a rising yield. So that helps the fund to continue to invest continue to maintain a good YTM. And third thing, as Sunena again pointed out, that as the interest rates would rise, probably because the growth would have picked up and the trade conditions, the economy would be doing well, the corporates would be performing well, and maybe there would be some credit upgrades, the earnings would improve, the credit upgrades would happen, so that would also help the credit papers. So all three things put together, that is how we would kind of encounter the rising yields.
Thank you. So we are committed to kind of serve you through our strong processes and portfolio construction methods, and hope to kind of have you back in our credit risk fund going forward. Thank you very much for joining once again, and thank you Sunena, Mohit, and Kaustubh for your views on the call.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.